Hey, welcome back to another episode of Building Wealth with Real Estate. I'm Cameron Ripley, the broker owner of Vision Forward Realty and Purpose Home Loans. And we are based out of the Roseville area in the greater Sacramento area of California. And so this podcast and this YouTube series or wherever platform you're watching this on, we're really diving into practical deals that are on the market and just all things, whether you're a first-time home buyer looking to build wealth and take advantage of home ownership, to a seasoned investor really looking to scale your portfolio, take advantage of tax deductions. And so I have found whenever I listen to a lot of different episodes on podcasts or YouTube, not to knock anyone's video series or podcast, but I just felt like I wasn't getting a lot of practical stuff. It was a lot of general concepts. And so I wanted someone to show me how you look at a deal, how you dive into it. And the more I started doing it myself and really looking at deals and saying, okay, well, how would this make sense for me? The more it made sense, right? Then we started putting together real estate funds. This episode is not to sell any real estate funds, but once we started doing that, it just all made sense and it clicked to the point where I can sit down with clients now and I can say, okay, where's your starting point? What are you working with? What's your situation? Okay, how do we get you to start? How do we get you to take advantage of tax deductions? How do we scale up from there? Like, what is the end goal game plan? How do we figure this all out? And so in this episode, we're going to dive into a really cool, unique property that I found in Roseville. It's a quadplex, so 4 units. They say that you could build an ADU. I'm not sure how true that is or not, but I think it has a lot of potential. In our last episode, we talked about buying a duplex in Citrus Heights, and it was listed at $580,000. Could you get to a point where you can scale that up and really increase the value? You put 20% down from your first property or whatever it is, but that was $116,000. Okay, well, now that you've scaled up that property and you have even more added value, what do you do with that money when you sell and do a 1031 exchange, or do you keep the property, do a second mortgage or something like that? So the way I would look at it, it would really depend on where interest rates are at, where the market's at, where your values have increased or not. In today's market, I'm just going to use the example of if I were to sell, what would I do? So I would do a 1031 exchange. Again, I would look at this as I'm going to keep some money to be able to renovate each one of these units for the quadplex. Maybe I have a little bit extra and I want to have an ADU financed in the purchase of buying this property. But I would really have to look at the property and really dive into, okay, can you build an ADU? Does it make sense? Or do you get more rent because there's a decent enough backyard space that people are going to pay more for rent? So this property is listed at 432 Fifth Street in Roseville. It's listed at $799,000. The listing agent is Daniel Valdez with eXp Realty. It is a quadplex, so 4 units. The total rents are at $5,553 per month. So that's $66,636 per year. So it's being advertised at an 8.33% cap rate. Good for you, Daniel, for finally listing a property at a cap rate that makes sense with interest rates and where the where the market's at today. Most of the properties I'm noticing that come on the market, they're being sold at a price that's way too high. Not to knock any listing agents out there, but there's a good chance that people are just yes man listing agents and they say, you want to sell at this? Yes, we'll sell it at that. But you forget that if interest rates are at high sevens and you're selling at a 6% cap rate, most investors are going to buy that property at a loss. Unless if you're looking for a cash buyer, which then you lower your buyer pool. And then it's, are you really trying to sell and move on to the next property? So good for him for selling at that cap rate. But what I would do is I would come in, right? 20% down on this property is $159,800. So with our previous property, we put 20% down at $116,000. You increase the values, you got up, so you had a little bit extra in order to either put down or use for renovations, and you buy this property. Now, each unit of this property is a different size, and so it depends where you want to start, the effort you want to put in. The nice thing about multiple units is it mitigates your chance of losing money during vacancy. So if I get a vacant property, I probably am making enough from the other properties that I can at least still handle all of my bills. So in my personal opinion, my risk tolerance goes a lot down, or my level of risk goes a lot lower the more units that there are. Why? Because if I have a duplex and each unit makes up the whole payment, well, the second that there's a vacancy, I have to make up that whole half of the mortgage payment. If I look at a multifamily, you know, a fourplex, one unit's vacant, I'm making up 1/4, or depending on which unit it is, right? I'm making up just a smaller portion. And so it's easier for me to operate. And this is where it gets fun, because when you're increasing the rent for each unit and you're increasing the value, you're going to see the values go up a lot faster. And so the more I can increase that $66,636 per year, I operate more efficiently. So let's just say that is their net operating income. I'm not too sure if it is. I have a feeling it's not. My goal would be to operate as efficiently as possible. The more your properties are renovated, the less requests for repairs you're going to get. It's not a proven science. It's not a guarantee, but just think about it. Okay. If you buy a property and you say, I'm going to throw lipstick on a pig and put in whatever crappy stuff I can manage to find because it's a renter, you're just going to get a lot more requests for renovations. And I think long-term, you're going to end up spending more than you would have if you would have just freaking renovated the place and put in good tenants. So that's our goal. The reason why I like this opportunity a lot is because Roseville is a great market. It's got really good school districts. Not to say that people who are renting it out have to be a part of the school districts, but values tend to go up just so much more. It's crime rate's a little bit lower as of right now. Whenever someone's watching this, I don't know. But it's just, it has more potential of a market. Your area median income's higher. Also, this is the key for those of you who look in all these random states out there, not knocking any other state, but what people forget to look at is, does the area median income increase every single year over the last 5 or 10 years at a rate that's greater than what I want to increase my rent at? So if area median income increases 5%, 4% year over year, and I'm wanting to increase at 3%, then great. It means that the market can support my increase in rent, right? Then it supports me adding more value to the property. If I'm buying in an area with a 2% median area increase every year, 2%, and I'm trying to increase the rent 3%, it just doesn't make sense. And you're going to get very frustrated. You're going to have more vacancy rates. So with this property, especially at 8.33% cap rate, I can probably buy it with a DSCR loan, meaning I don't have to qualify off my own income. So if I am highly leveraged and I have a lot of other investment properties, hint, hint, if I own the other one and maybe there's a vacancy right there or whatever, and someone's, doing the loan and they're calculating it, I can probably just do a debt service coverage ratio loan where I just qualify off the income that the property is currently producing. So usually that's a 1.25% ratio. That's what the DSCR ratio is. It varies from lender to lender. Some lenders will offer lower, but the rate comes higher, so then it just is a wash. What I would do if I was you is just sit down with someone like me or someone from our team or someone else, someone who knows this kind of stuff, and just go over your options with each property, because you're going to start to understand it yourself. And then when we go and look at different properties, it's an easier and quicker conversation where we can jump on the opportunity and make a decision. So I buy this one, I increase rent 3% every year. I do some upgrades and some value adds, right? This isn't a property. I think where it's starting at is really good. So if I am an investor who just kind of wants to buy something, increase my rent every year without having to do too much and be too aggressive with all the repairs and upgrades, this is a great opportunity. It's going to cash flow from day one, depending on where interest rates are at, of course, on the day you purchase. But it should be cash flowing when I've done a lot of the math with 20% down in today's rates. So assuming that you're not making a ton of repairs. But I'm going to go in there. I'm going to do a lot of updates myself because I want to scale even bigger than this is my goal. Everyone's goal is different, right? I increase rent 3% every year. Tenants are going to move out. I'm going to renovate it and I'm going to dramatically increase the rent because when a new tenant comes in, it's going to be a brand new place. I'm going to make sure that the backyard, now this is key that I like to talk about with a lot of these, 1 to 4 units, is most of them have backyards. I'm going to put some effort into the backyard. Low maintenance so that I'm not having to pay a lot for someone to come out and clean it all the time, a gardener or landscaper, but I'm going to put some effort into it because I want it to look nice. You can increase the value by quite a bit. Now, what we're going to look at, depending on which of those options I gave, whether you're the investor who just wants to look at this from the standpoint of, I'm going to increase rent 3%, 4% every year, and I'm going to wait and just sit on it and let the value increase, or I'm going to be aggressive with it. From there, we're going to look at, okay, are you wanting to do a 1031 exchange in 5 years or just sit with this property? Let's say you are after 5 years, or you want to do a 1031 exchange after 2 or 3. Okay, well, how can we get the value to where you can scale up from there? And our next property we're going to look at is a 6-unit apartment with a lot of upside potential, a lot more income to work with, a lot higher starting price, which just means when appreciation takes effect, you have a lot more increase in value because the starting price, right, if it's a percentage, goes up more. So look forward to talking to you all in the next episode. If you have any questions about any of this, feel free to schedule a time. You can email us or call us on our website, or just go to info@visionforwardrealty.com or info@purposehomeloans.com, and we'd be happy to help you. So thank you.